Imagine two friends. Both start with the same salary, the same education, and the same dream to become financially free. The first friend spends years chasing hot stocks. Every week, he watches financial news, follows influencers, buys stocks after they go viral, and sells them when fear takes over. 5 years later, he has worked hard, but his wealth has barely grown. The second friend is different. He waits patiently. He studies businesses instead of stock prices. When everyone is afraid, he quietly buys great companies at low prices. He doesn't need to be right every day. He only needs to be right a few times. 10 years later, the first friend is still chasing opportunities. The second friend owns freedom. What made the difference? Not intelligence, not luck, not a secret formula. It was one simple philosophy. Heads, I win. Tails, I don't lose much. This is the heart of the Dhandho Investor. Today, you'll discover how some of the world's smartest investors minimize risk while maximizing rewards, and how you can apply the same mindset to your own financial life. What does Dhandho mean? The word Dhandho comes from the Gujarati language and simply means business. But in this book, Dhandho represents much more than running a business. It represents a mindset. A Dhandho investor constantly asks, how can I make a lot if things go right, while losing very little if things go wrong? Most people think investing is about predicting the future. The Dhandho philosophy says something completely different. Instead of trying to predict tomorrow, protect yourself from losing today. Because if you avoid major losses, your wealth has time to grow. The biggest mistake most investors make. Imagine entering a casino. Every game is designed so the casino has a tiny advantage. It may only be 2%. But after thousands of games, the casino almost always wins. Now imagine doing the opposite. Instead of playing games where the odds are against you, you only play games where the odds strongly favor you. That's exactly how successful investors think. Unfortunately, most beginners do the opposite. They invest based on emotions. When prices rise, excitement takes over. When prices fall, panic begins. Fear and greed become their investment strategy. The Dhandho investor refuses to play that game. Instead, they wait for opportunities where the probability of success is heavily in their favor. Patience becomes their greatest advantage. By existing businesses instead of chasing dreams. Many people dream of creating the next billion-dollar startup. But startups fail every day. Instead of risking everything on an uncertain business, why not buy a small ownership in an already successful company? When you purchase shares of a profitable company, you're becoming a part owner of a real business. That company already has customers. It already earns money. It already has management. You're simply becoming a partner. This mindset completely changes investing. Instead of looking at stock charts, start looking at businesses. Ask yourself, would I want to own this company if the stock market closed for 5 years? If the answer is yes, you're thinking like a business owner instead of a trader. A simple story. Imagine there are 2 restaurants. The first restaurant is brand new. Nobody knows if customers will come. Nobody knows if the food is good. Nobody knows whether it will survive. The second restaurant has been packed every evening for the last 20 years. People wait outside for a table. The owner earns consistent profits. If both businesses cost the same amount, which one would you choose? Almost everyone would choose the second. Yet many investors do the opposite in the stock market. They chase exciting stories instead of proven businesses. The Dhandho philosophy teaches us to prefer certainty over excitement. Focus on low risk, high uncertainty. This sounds confusing. Low risk, high uncertainty. Aren't they the same? Not at all. Imagine a luxury hotel temporarily closes because of a short-term crisis. Its profits decline for 1 year. Investors panic. The stock price drops by 50%. But the hotel still owns valuable land. People will eventually travel again. The business is temporarily uncertain. But the permanent risk may actually be very low. Now imagine another company promising revolutionary technology. Everyone is excited. Its stock price doubles every month. But it has never earned any profit. That company may feel certain because everyone loves it. In reality, its risk is much higher. The Dhandho investor looks for situations where uncertainty creates bargains. Margin of safety. Imagine buying a beautiful house worth 1 crore rupees. One seller offers it for 95 lakh rupees. Another seller offers it for 50 lakh rupees because he urgently needs money. Which deal protects you better? Obviously, buying for 50 lakh rupees. Even if property prices fall, you're still relatively safe. The same principle applies to investing. Never buy wonderful businesses at unreasonable prices. Instead, wait until temporary fear creates discounts. The lower your purchase price, the greater your margin of safety. This simple idea has protected successful investors for decades. Patience beats activity. Modern investing encourages constant action. Buy today, sell tomorrow. Check prices every hour. But wealth rarely grows through constant movement. Think about a farmer. After planting seeds, does he dig them up every morning to check whether they're growing? Of course not. He waters them, protects them, waits patiently. Investing works the same way. Buying great businesses is only half the journey. Allowing time to multiply your returns is the other half. Patience often earns more money than intelligence. Real life example. Imagine two investors each invest 1 lakh rupees. The first investor constantly trades. He earns small profits but also pays taxes, brokerage fees, and makes emotional mistakes. After years of stress, his portfolio barely grows. The second investor carefully buys excellent companies at attractive prices. Then he simply waits. Those businesses continue growing. Profits increase. The companies expand. Years later, his wealth quietly multiplies. The difference wasn't working harder. It was avoiding unnecessary decisions. Buy $1 for 50 cents. Imagine walking into a shopping mall during a massive clearance sale. A premium jacket worth 10,000 rupees is available for just 5,000 rupees. The quality hasn't changed. Only the price has. Most people understand discounts when buying clothes, phones, or groceries. But when it comes to stocks, they often do the opposite. They rush to buy when prices are high because everyone else is buying, and they panic when prices fall. The Dhandho philosophy flips this behavior. A falling price isn't always bad. Sometimes it's an opportunity, provided the business itself remains strong. Successful investors don't ask, is the stock price rising? They ask, is this business worth much more than today's price? Buying a valuable business at a significant discount gives you room for mistakes and increases the potential for long-term gains. Ignore the crowd. Picture a busy marketplace. One person starts running. Without knowing the reason, others begin running too. Soon, hundreds of people are running, driven by fear rather than facts. This happens in the stock market every day. When markets soar, people believe prices will rise forever. When markets crash, many assume everything is doomed. But history tells a different story. Markets move in cycles. Fear and greed come and go. The Dhandho investor remains calm. Instead of following headlines, they study businesses. Instead of reacting emotionally, they rely on facts. Remember this. The crowd often reacts. Great investors think. A story about patience. Imagine a fisherman standing beside a river. He doesn't jump into the water every minute trying to catch fish with his hands. He prepares his equipment, chooses the right location, casts the line, and waits. Sometimes he waits for hours. His patience isn't laziness, it's strategy. Investing works the same way. You don't need to buy every week. You don't need to own dozens of stocks. You simply need a few outstanding opportunities purchased at the right price. Patience often looks boring in the short term, but becomes incredibly rewarding over the years. Focus on your best ideas. Many beginners believe that owning 50 or 60 stocks automatically makes them safer. But imagine trying to water 50 different plants every day. Some will inevitably be neglected. Now imagine caring for just 5 healthy trees. You can monitor them closely, protect them, and help them grow. The same applies to investing. The Dhandho philosophy encourages thoughtful concentration rather than blind diversification. This doesn't mean putting all your money into one company. It means investing only in businesses you truly understand and have researched thoroughly. Quality matters far more than quantity. Learn from mistakes without repeating them. Every investor makes mistakes. Even the world's greatest investors have experienced losses. The difference is how they respond. Some people lose money and blame the market. Others lose money and ask, "What can I learn from this?" Growth begins when responsibility replaces excuses. Keep a simple investing journal. Write down why you bought a company, what you expected, and what actually happened. Over time, patterns will emerge. You'll begin to recognize emotional decisions, rushed judgments, and repeated errors. Learning from your own experiences is one of the fastest ways to improve. Keep emotions under control. Imagine driving a car during heavy rain. Would you speed up because everyone else is? Or would you slow down, stay alert, and make careful decisions? Investing during market volatility is similar. Fear whispers, "Sell everything." Greed shouts, "Buy before it's too late." Neither voice deserves complete control. The Dhandho investor relies on discipline instead of emotion. When everyone is celebrating, they remain cautious. When everyone is fearful, they look for opportunities. Emotional control isn't just an investing skill. It's a life skill. The power of compounding. Many people underestimate the power of small, consistent growth. Imagine planting a mango tree today. You won't enjoy fruit next week or next month. But if you care for it year after year, it eventually provides shade, fruit, and value for decades. Investments work the same way. Compounding rewards those who stay invested in quality businesses over long periods. The earlier you start and the longer you remain patient, the more powerful compounding becomes. Time is often a greater advantage than perfect timing. Real-life mindset. Think of two individuals. The first spends every evening worrying about market movements, refreshing stock prices every few minutes. The second spends that same time learning about businesses, reading annual reports, improving financial knowledge, and patiently waiting for attractive opportunities. After 10 years, who is more likely to succeed? Usually, it's not the one who watched the market every minute. It's the one who improved their thinking. Knowledge compounds just like money. The biggest takeaway. The Dhandho philosophy isn't only about investing. It's about decision-making. Before starting a business, before changing careers, before making a major financial commitment, ask yourself, what is the potential reward? What is the maximum possible loss? Can I survive if things don't go as planned? Am I making this decision based on facts or emotions? These simple questions can help you avoid costly mistakes and make smarter choices throughout life. Final conclusion. The greatest investors aren't gamblers. They don't chase excitement. They don't panic during market crashes. They don't follow every trend. Instead, they patiently search for situations where the downside is limited and the upside is significant. They think independently. They value patience over speed. They protect their capital before chasing profits. And they understand that true wealth isn't built overnight. It's built through disciplined decisions repeated consistently over many years. Remember the core principle of the Dhandho investor. Take small risks for potentially large rewards. That's not only a smart investing strategy. It's a smart way to live. If you found value in today's summary, remember that reading one great book can change your mindset, but applying its lessons can change your life. Every successful investor started as a beginner. They didn't have perfect knowledge or unlimited money. What they had was the willingness to keep learning, stay patient, and make better decisions one step at a time. If you want more book summaries on investing, personal finance, self-improvement, and wealth creation, make sure to subscribe to this channel and turn on notifications. Every video is designed to save you hours of reading while delivering the key ideas you can apply immediately. If this summary helped you see investing from a new perspective, share it with a friend or family member. Sometimes, one lesson shared today can become someone else's financial turning point tomorrow. Thank you for watching, and remember, don't chase quick riches. Build lasting wealth through patience, wisdom, and disciplined decisions. I'll see you in the next book summary.